Okay, students, so we have two different schools of thought in terms of how the market behaves. So I'll help you out with two different schools of thought. Initially, what everybody used to say is, look, everything can be studied using different patterns, and for that you had all of these big formulas that you can use, and how you can use formulas to calculate what will happen in the future, how you can create a portfolio and everything. So the basic premise was this, like, I'm going to divide these two premises into two different sets, so that you understand. The first one is your traditional approach, okay, in which everybody would say, look, stock prices move in a certain pattern, okay, and because of this, you can, if you understand the pattern, you can understand what will happen in the future. This case, as they're saying, let's assume this is your normal, the stock is moving in this pattern. I'm going to show this pattern here, 1 2 3, and the next question is, what will happen in the future? So I'm putting a question mark here. 90% or even 99% of you might say, look sir, this is a fairly simple answer. Always what will happen is, you will always have this situation wherein stock price will go downwards. Why would you come at that conclusion? Because you have seen the previous data and you've understood that there is a high degree of probability now this will go this side. But according to a different school of thought, what they say is, look, everything happens in a very simple pattern, which is random. They say there is no pattern to it. Everything is completely random. So if you're trying to assign patterns to everything, it might not work. For example, let's assume if everything happens in a pattern, then you can easily predict the future. Then everybody can predict the future and everybody will do the same thing. Then there'll be no highs and lows in the market. There'll be no gap in the market. There's no scope for speculation. If that happens, then nobody will go to the market. So that is why what people say is, look, you cannot predict everything that is happening around you. So that is why what they're saying is, look, things can be random. Everything does not move in patterns and charts. So whenever you look at it, you will have a certain situation wherein you will see that things move in a random pattern. So this is where you had a specific school of thought who said that, look, there is a different theory known as random walk. Random walk means, if you look at a chart pattern, what they're saying, look, this is completely random. We have no idea of what is going to happen next. Everything is random. So you cannot say that chart, this, you cannot predict what will happen in the future looking at this. This can happen at any point. Anything can happen at any point because everything is random. This is how they are defining random. So random walk theory says that, look, stock market as such is a reflection of what is happening in the ground. So if you have a good market or an efficient market, I'm going to use that word efficient again. I'm going to help you out what efficient means. Now, efficiency means a market that interprets all the information and processes the stock prices accordingly. So that is the basic logic of a stock market. So it says, look, everything is random. So whatever information comes in about the stocks and about the markets, and if that information is positive, stocks will go up. If the information is negative, stocks will go down. This is the basic premise of having demand and supply ruling your stock market. This is how stock market functions. This is what they're saying. But you cannot predict what kind of information is going to come in because things happening around you are completely random. So based on that, they're saying, look, everything is random. So that is where you've seen this something known as this theory would come in EMH, or your efficient market hypothesis. Okay. So before we come into efficient market hypothesis, we'll understand the concept of market efficiency. Now, market efficiency as such is divided into two. The market efficiency is divided into two. One is your operational efficiency, and second one is your informational efficiency. Now, operational efficiency means how efficient are the different processes that are done in the market. For example, there are many transactions happening in the market and there are many things that are traded in the market. So, operational efficiency means how efficient is that operation, the number of faults that might happen during the system, and the number of errors that might come in. So, the lesser the number of errors, the more efficient the system is. So, that is your basic operational efficiency, how the market functions and how different day-to-day operations are conducted. So, how the least number of errors and at the minimum cost is your operational efficiency. Now, informational efficiency is where random walk comes in. Now, it says that use a specific known as discounts or discounting. They always say, look, the market discounts information and reflects prices accordingly. That means if there is a specific information that is coming into the market, for example, there is a war, let's assume there is a war between India and China, and you see this news in the television channel. What will happen next is the market are going to fall down. The markets are going to fall down because everybody will now start to assume that the prices are going to come down, the economy is going to come down. What will happen? The stock prices will also come down. Let's exit the market. That is what everybody will do. Now, this is purely based on the information that has been processed by the people in the market, the information that was outside. So, informational efficiency specifically is divided into three types of efficiencies in this case, which is in this case, I'm going to explain this again, which is your weak form, semi-strong form, and your strong form. So you have weak form of efficiency, semi-strong, and your strong form of efficiency. So I'll explain these three efficiencies here. So before that, we'll come to this thing that we were discussing before, which was your efficient market theory, which actually describes the thing that we discussed before, which is your market efficiency, which can be divided into, we've discussed that before, operational efficiency and informational efficiency. And then you have your EMH. Now, EMH in this specific case, which is your efficient market hypothesis, means that the market discounts information, that is, takes into account the information that is coming from outside and reflects the prices accordingly. And whatever prices you see on the market are the actual reflection of the events that affect the market. And that is what EMH basically means. So EMH is based on three forms. They say that there are three forms of market efficiency. As I said before, you have strong, semi-strong, and also weak. So I'll help you out with what these three mean. So with a simple, fairly simple diagram, I'm going to put those three things in three different columns. You have your weak, you have your semi-strong, and you also have your strong form of efficiency. In case of weak, what they will say is the market is so weak that it processes only historical information. Historical information means things that have already happened. That, for example, the things have happened and you're reading it in the newspaper. Now, this happened a long back. So now market is getting that information and it is processing it. So that means the market is not very efficient in how it discounts information or how it processes information. So that is a very weak form of a market efficiency also, if you can call it. So this is the first thing that you need to understand. Then you have your second one is your public information. Public information means in this case, if you look at the semi-strong, this one, semi-strong means it processes historical information and all publicly available information. That is, for example, something has happened and that information is available on the internet, that information is available on TV, you go anywhere, you have the information available, it is of public information. So semi-strong form of efficiency reflects both historical information and also your public information. Then you have next one is your insider information also. Insider information. Now, insider information in this case is something that even people do not know. And only people inside the company know or inside the market know what is going to happen. So that information, when that information is also processed, that is sometimes you have certain rumors going around. So prices reflect those rumors also. So in that case, your market is so efficient that it is reflecting historical information, it is reflecting publicly available information, it is also reflecting your insider information. So these are three basic criteria of efficiency. That is your weak, which processes only historical information. Then you have a semi-strong, which processes historical information and your publicly available information. Then you have your strong form of efficiency, which processes historical information, publicly available information, and also your insider information. So when you club all of these three things together, you will see this here. I'll show you. This is basically your three forms of efficiency, wherein you have a weak form, as I said before, only historical prices and returns, your semi-strong, historical, and all publicly available information, and strong form means you also have your historical, publicly available, and your private information also. Now, EMH, everybody applies EMH to understand what is happening to the market. Now, you can never beat the market. That is something that we need to understand as investors. But by studying all of these theories, you can understand how the market is functioning and how you need to react to it. That is how the benefit of EMH comes to every investor. So you need to understand how stocks move up, how stocks move down. You can say it is basically demand and supply, but there are many other factors also that influence demand and supply. Demand and supply is what is moving the stocks up and down. But there are certain factors that influence demand and supply. So if you understand that factors and how market discounts those factors, that is how you will understand how your stock prices are going to move up or going to come down. And this is where they say, look, these factors cannot be predicted. So that is why we have your random walk theory. So they say that everything is moving in a random pattern. And once you understand that everything is random, there is no point in going into historical information. All you need to do is wait for something to happen and then react accordingly. That is what random walk theory says. And because of this, too many traders, because they are very dependent on historical charts and patterns, they tend to predict something that is not going to happen. So they get into a lot of trouble. So that is why people say, look, take into account random walk also, take into account random figures also. So if you only depend on charts and figures, what you can do is you might understand what is happening in the market, but you cannot predict the market. You have a lot of now people do not use, maybe tomorrow they do not use manual calculations now. They have all of these big algorithms, big computer softwares running algorithms to calculate what will happen in the future. But even that everybody has today. So then what is the point of doing all of that when everybody can predict what is happening in the future? So you cannot do that. So there will be some degree of randomness in every system. So that some degree of randomness is what everybody is looking for when they come into the market. And there are certain criticisms also, because some things have some charts and patterns. You can understand, if you look at certain charts and patterns, you will understand, look, this is something that you can understand. As I said before, something is going up, it is coming down, then it is again going up. So you will understand that this is going to happen next. So there are certain things that you can understand, but what they say is, look, there is this argument for random walk also. You cannot predict everything also. So that is how both of these things are related. And this is where I'll end my class. Thank you so much.